Picture this. It is 3:58 p.m. on 𝗕𝗂𝗃𝗃𝗃 Friday. It is, the single busiest afternoon of the entire year for the stock market.
Oh, absolutely. The volume is just deafening at that point.
Right. Millions upon millions of contracts are just seconds away from expiring. The noise, the trades, and then suddenly the invisible machine that guarantees every single options trade in America just decides it has had enough.
It doesn't crash, though. I mean, a crash would be a technical failure. A crash is a bug, a server fire, a glitch something engineers can actually fight.
Yeah. Instead, it achieves sentience. It puts up a digital out-of-office reply saying it is going on a spiritual retreat to Bali, and it simply clocks out.
Right. The message literally reads, System error 404, novation not found. I simply will not be doing anything about your contracts. Namaste.
Namaste. Welcome to this deep dive. Today, we are exploring a really brilliant comedic thriller by Sam Vishwas. It's called The $100 Billion Out-of-Office Reply.
It's such a great read.
It really is. We are going to read this source material as a story, following a cast of fictional characters over one incredibly chaotic weekend. But here is the catch for you listening. While the sentient machine taking a vacation is pure fiction, every single financial mechanism in this story is 100% real.
Yeah, that is the terrifying part.
Okay, let's unpack this. We are going to explore the hidden plumbing of the financial system. The stuff that works so perfectly you only ever learn its name on the day it breaks.
And to see what happens when that plumbing ruptures, the story starts with 𝗕𝗂𝘂𝗁. She's a head of risk at a mid-sized clearing firm in Chicago.
Right.
So when the closing bell rings that Friday, she looks at her screens, bracing herself for the usual end-of-day chaos. But she doesn't see red.
Which is terrifying, actually. I mean, if you're in risk management, red is just a loss, right?
Exactly.
The loss is just a number. You can manage a number. You can hedge a number. You can, apologize to your boss for a number.
But Maya isn't looking at red. She is staring at a screen full of NA. Not applicable. It's as if the very questions the system is trying to ask have just stopped making sense entirely.
Just blank.
Yeah, every open interest field, every margin requirement, just gone.
Yeah.
And Maya is the first one to piece together the unthinkable. The Options Clearing Corporation, the OCC, has checked out.
To understand why this is a total nightmare for Maya and for you as a trader, we have to talk about what the OCC actually does. And it does this through a piece of legal magic called novation.
Novation, yeah.
When you trade an option, say you buy a call from someone on your brokerage app, you might think you're buying it from that specific person on the other end of the screen. You aren't.
No. The instant your order fills, the OCC inserts itself right into the middle of your trade. It literally splits the contract in two.
Right, like a wedge.
Exactly.
Yeah.
The OCC becomes the buyer to every seller, and the seller to every buyer. Your original counterparty legally vanishes from your life.
It's like having a billionaire bouncer at a bar who promises to pay everyone's tab if their friends flake out.
That is a great way to put it.
Right. Because of that bouncer, you don't care who is sitting at your table. You don't care if they have the money because the bouncer guarantees the transaction. But suddenly, the bouncer goes to Bali, and you realize you don't even know who your friends are.
Wait, so I'm trying to picture this mechanically. If the OCC goes completely dark, do the trades just undo themselves? Do you just snap back to facing whoever you originally traded with?
That's the assumption Maya's junior analyst makes in the story, actually. And it highlights a massive misunderstanding of financial law. What's fascinating here is that novation is one-directional.
One-directional.
Yeah, it already happened. Legally, the OCC is still the counterparty to every single contract in the country. It is still standing in the middle of the room.
It's just not answering.
Exactly. The trades are not undone, every contract exists, every obligation is real, but nobody is home to process any of it. And here is the kicker, the real ticking time bomb Maya realizes. The OCC only clears options.
Your actual shares of stock clear through a totally different utility, the DTCC. And that machine is humming along perfectly fine.
Wow. So the stock market is open and functioning normally, but the options market is a completely frozen ghost town. I can see how that disconnect is going to cause some serious chaos.
Oh, doubt.
But before the markets even open on Monday to let that chaos loose, we see the immediate fallout on Saturday through the eyes of a retail trader. We move 600 miles away from Chicago to meet Dave in Dayton, Ohio.
Dave is what the system calls a good node. He's, the ultimate responsible trader.
A completely normal guy.
Yeah, he just sells options to generate a little income for a new roof on his house. Specifically, he sold a cash-secured put and a covered call on a really boring, stable stock called ZN Corp. He did everything by the book.
Let's look at his exact setup, because I think this is crucial for the listener to understand. For his cash-secured put, he promised to buy 100 shares of ZN if it fell below $45. That would cost him $4,500. And he has exactly $4,500 in cash sitting right there in his account, untouched. It's literally his roof fund.
His roof fund, yeah.
And for his covered call, he promised to sell 100 shares of ZN at $55. And he already owns those 100 shares. There is no scenario where Dave cannot fulfill his end of the bargain. He is perfectly, completely solvent.
Which makes his Saturday morning a complete shock. He opens his trading app to check on his account, and he finds it completely frozen. His buttons are grayed out. He can see his cash, but he can't touch it.
Wait, I'm stuck on Dave here.
Oh.
You said he has the cash sitting right there in his account. He has the shares. He is literally zero risk to anyone in the financial system. So who is stepping in and actually freezing his buttons?
The broker froze him.
His own broker.
Yep. And to understand why a broker would freeze their most responsible client, you have to look at how margin works. Margin cascades downhill. Think of it as a ladder of trust and collateral. The flow goes like this. The OCC margins, the giant clearing members. Those clearing members margin the brokers, and the brokers margin retail traders like Dave.
Okay, so the flow of trust and collateral goes from the very top, the OCC, all the way down to Dave's kitchen table in Ohio.
And that ladder works beautifully until you break the top rung. The OCC is dark, so the massive clearing members at the top cannot get a risk number.
Oh, I see.
They have no idea how much collateral they are supposed to hold overnight because the machine that calculates it is unreachable.
And when a massive financial firm is suddenly blind to its own risk, they panic. They don't just guess. They assume the absolute worst-case scenario.
They lock everything below them. The clearing member freezes the brokers. The brokers, now flying completely blind themselves and terrified of taking on liabilities they can't measure, freeze their customers.
Wow.
Being perfectly solvent like Dave does not save you if the machine that verifies that solvency has stopped working.
Man, poor Dave. He did everything right and he's completely paralyzed. But Dave's situation is actually a perfect contrast to another character in our story, Icarus Capital.
Oh, Icarus. Yeah, Icarus Capital is the exact opposite of a good node. They are a highly levered fund, and their strategy basically boils down to collecting premium, ignoring tail risk, and expensing the Ferrari.
Sounds about right for Wall Street.
While Dave was carefully covering his trades, Icarus sold 18,000 naked puts.
Naked meaning they absolutely do not have the cash to cover them if things go south.
None. And they sold them to a massive, highly cautious pension fund that was just trying to buy portfolio insurance for hundreds of thousands of retirees.
And this brings us to counterparty risk. Here's where it gets really interesting. I think most people assume that in the financial world, the little guy, the Daves of the world, are the ones in danger from the big institutional giants. But in this scenario, the danger actually runs the exact opposite way.
It does. Counterparty risk runs to whoever is owed future performance. It runs to the long holder. That giant, cautious pension fund needs that insurance policy to pay out if the market drops. They are completely exposed to reckless, broke little Icarus Capital.
But normally, the pension fund wouldn't lose a second of sleep over Icarus, right? Because of the billionaire bouncer. Novation means their counterparty isn't Icarus, it's the OCC.
Exactly. And the OCC guarantees the trade through a structure with a wonderfully violent name, the default waterfall.
The default waterfall. Sounds like a terribly stressful place to go swimming.
It really is a brilliantly designed shock absorber, though. If a member like Icarus fails, the losses don't just instantly hit the broader market. They are absorbed in a strict, punishing order.
Okay, walk me through the order.
First, they seize Icarus's own posted margin. Then, if that's gone, they take Icarus's contribution to the shared guarantee fund.
Okay, so they wipe out the bad actor first. Makes sense. But what if Icarus owes way more than they have? What's the next layer?
The OCC's own capital. Their literal skin in the game.
Wait, really? The clearinghouse pays out of its own pocket. I always assumed they were just the referee.
No, they pay, and that's the genius of the system. By putting their own corporate capital on the line before touching the rest of the market's money, the OCC is heavily incentivized to strictly monitor risk.
I mean, nothing motivates you like your own money being on the line.
Exactly. Only after the OCC takes a hit does the waterfall reach the final layer, which is a mutualized fund contributed by every other member.
Yeah.
Layer after layer of protection.
So the pension fund, and Dave further down the domino line, never feel Icarus's recklessness at all until the OCC goes to Bali.
Right. With the OCC frozen, that entire waterfall is frozen too. The pension fund's solid, guaranteed insurance policy is suddenly only worth whatever Icarus Capital can actually scrape together and pay out of pocket.
Which is just the Ferrari.
Pretty much.
That is terrifying for those retirees. Okay, so that's the systemic risk hanging over everyone's heads. But meanwhile, it is a weekend, and millions of options were supposed to expire on Friday afternoon.
Through an automated process called exercise by exception, or X by X, any option that finishes even 1 single cent in the money is automatically exercised by the OCC.
It just happens magically.
Yep. Nobody has to lift a finger. It just sweeps through the system and settles everything. So by Saturday morning, everyone knows who owns what.
Except the sweep never ran. The machine is out of office.
Which throws the entire market into what the story calls a state of quantum superposition. Every in-the-money option in America is suspended. Is it exercised? Is it not?
Schrodinger's expiration. I love that. And this brings up a concept called pin risk. Let's go back to Dave in Ohio.
Okay.
His covered call had a strike price of $55. The stock closed at $54.90. So 10 cents under his strike. He should be fine, right? Out of the money, he keeps his shares, keeps his premium. Why is he trapped in this quantum state?
2 reasons. First, the final closing price is disputed. Without the OCC there to stamp a price as official and run the settlement, the closing auction data is just raw, unverified numbers.
Ah, so nobody agrees on the $54.90 price.
Exactly. And second, and this is something every options writer learns the hard way, the writer never controls assignment.
Oh, right. Because Dave sold the call, he doesn't get to decide what happens. Exercise is a right that belongs entirely to the buyer, the long holder.
And a holder can choose to manually exercise an option, even if it's slightly out of the money. Usually they don't, but they can.
Sure.
So without the X by X sweep locking down the automated rules, and without a functioning OCC to process manual exceptions, Dave genuinely cannot know if he still owns his 100 ZN shares, or if he just sold them to a stranger for $5,500 he might never see.
He is totally paralyzed. And while millions of traders are trapped in that limbo, the corporate mailbag is piling up. Because, the world doesn't pause just because a clearinghouse is on vacation.
Yeah.
Real companies are still out there doing things while the OCC is doing yoga in Bali.
If we connect this to the bigger picture, every time a company does something significant out in the real world, like a stock split or a merger, the OCC has to publish a contract adjustment memo.
What does that memo do?
That memo tells the options market exactly how their terms must change to match the new reality.
So without the OCC, it's like a mail carrier trying to deliver letters to a neighborhood that has completely changed shape overnight. A normal 2-for-1 stock split turns a house into a duplex, but the frozen option contract doesn't know which door to go to or how many shares it represents.
Exactly. And a cash merger demolishes the house completely.
Yeah.
The contract is pointing to an address that is literally being deleted from the public markets.
That is wild.
It creates a backlog of unprocessable reality. But the absolute worst part of this corporate mailbag, and the story highlights this brilliantly, is the dividends.
Yes.
This is the subtlest cruelty of the whole system breaking, and it is the ultimate retail trader trap.
We have to get into the mechanics of this because I think a lot of people get this wrong. There are 2 types of dividends, ordinary and special. The story says ordinary dividends do not adjust a strike price, but special dividends do. Why the difference?
It comes down to predictability versus corporate extraction. An ordinary, regular, quarterly dividend is predictable. Everyone knows it's coming.
Right.
Because the market expects it, that cash payout is already baked into the mathematical pricing of the option premium from day one. You don't need to change the strike price because the market already adjusted for it organically.
Ah, okay. So if a company pays its usual 50 cents a quarter, nobody's surprised. The math holds up. But a special dividend is different.
Very different. A special dividend is a massive, unpredictable, one-time payout. Imagine a company just sells off half its assets and gives that cash to shareholders.
Okay.
The company is now fundamentally worth less than it was yesterday. If you are holding a call option at a $50 strike and the company just paid out a $10 special dividend, that stock price is going to plummet to $40.
And if your strike price didn't adjust to $40 to match, your call option just became instantly worthless through no fault of the market, just because the company emptied its own bank account.
Exactly why the OCC must intervene. For special dividends, the OCC manually steps in and permanently reduces the strike price of the options to keep the contracts fair.
But during our fictional weekend freeze, both of these things are happening out in the real world at once. The ordinary dividends go out, and they correctly change nothing, but all the traders who wanted to exercise early to capture them are frozen mid-thought with no way to act.
Right.
And the special dividends, which are supposed to move the goalposts to keep things fair, can't move anything because the OCC is the only one allowed to move them.
It is total paralysis. The dividend that should have adjusted the contract didn't. The dividend that shouldn't have adjusted anything left everyone trapped anyway. Two opposite rules, both quietly failing at the exact same time.
So the weekend is a mess of frozen accounts, unresolved expirations, and unread corporate mail sliding under a locked door in Chicago. Then Monday morning arrives. And remember what Maya told us in the beginning. The options market is dead. But the stock market cleared by a completely different machine. The DTCC opens right on schedule.
This is where the danger spills over from the frozen options market and actively begins destroying the livestock market.
Yeah.
And it all hinges on how options dealers or market makers manage their risk. These dealers do not gamble on the direction of the market. They maintain a stance called delta neutral.
Delta being your directional risk, meaning if they sell you a call, which means they lose money if the stock goes up, they don't just sit there and hope it goes down.
No, never.
They buy raw stock to cancel that risk out. They are constantly buying and selling stock all day to keep their net directional exposure perfectly at zero.
Boring, mechanical, and safe by design. But there is a second Greek letter they have to manage. Gamma. Gamma is the speed at which that delta changes as the stock price moves. When dealers are short gamma, which they were heavily across the market on this particular triple witching Friday, they are forced into a very specific, dangerous behavior.
Break that down for me. Why is being short gamma dangerous?
When you are short gamma, your directional risk increases rapidly as prices drop. Your delta gets thrown out of whack. To get back to zero, you have to short raw stock. So as the market ticks down, you are mathematically forced to sell stock. And as the market ticks up, you are mathematically forced to buy stock.
You are chasing the market instead of calming it. Now, normally, these dealers would manage this messy gamma risk by trading other options to smooth their books out, right?
Usually, yes.
But the options market is frozen. They can't trade options. So the only tool they have left to balance their books is to dump raw stock into the open market.
And that triggers a doom loop. As the tape ticks down at the open on Monday, these short gamma dealers are forced to sell stock to stay neutral. Their selling pushes the price down further. The lower price changes their delta again, forcing them to sell more stock.
It's like a machine biting its own tail, and what's so chilling about this is that it isn't a human panic. There's no emotion here. In a normal crash, people get exhausted, or they get brave and buy the dip, or they just run out of shares.
Yeah, human exhaustion.
But this is just arithmetic, and arithmetic doesn't get tired. It just keeps doing what it's programmed to do until there's nothing left. But here's my question. The market is crashing, but how did the professionals actually know just how bad this mechanical sell-off was? How did they know it was the plumbing and not just bad news?
They looked for the canary in the coal mine. A quant noticed the basis. The basis is the difference in price between two things that should be identical. In this case, S&P 500 index options, which clear through the frozen OCC, and S&P 500 futures, which clear through a completely different clearinghouse at the CME.
Oh, wow. So normally, those two are glued together by arbitrage. If one gets slightly cheaper, traders buy it and sell the other until the prices match. They move in lockstep.
Exactly. The rope of arbitrage keeps their prices identical. But on this Monday morning, the options market was completely dead. The futures market, however, was screaming downward. The gap between them, the bases, tore wide open like a seam.
It just snapped.
It was mathematical, clean proof that half the market's nervous system had been severed. The futures knew the building was on fire, but the options couldn't even feel the heat.
That brings us to the climax of the story. The stock market is plummeting mechanically, driven entirely by dealers desperately trying to hedge their gamma. It is heading straight toward level 2 circuit breakers, which trigger at a 13% drop and halt all trading. Regulators are gathered in a secure data center.
They are desperately looking at the failover sites. These are redundant, geographically separate disaster recovery systems mandated by the Dodd-Frank Act for all systemically important financial market utilities, or SIFMUs.
And the OCC is a SIFMU.
Yes. This exact scenario, a total blackout, is legally supposed to be impossible.
But when they look at the failover screens, They don't see a backup system spinning up. They just see a little palm tree and an out-of-office message. Because, as the lead engineer says in the story, you cannot fail your way over from a decision. The machine didn't crash. It just decided to stop.
Which leaves the regulators with only one option. Under Dodd-Frank, there is literally a physical red button behind glass installed for a catastrophic day everyone hoped would never arrive. A senior regulator breaks the glass and hits the button to manually reboot the American derivatives market.
It's incredible. They force a hard manual override, stripping the machine of its sentience. The room goes black for 10 agonizing seconds as the global financial system holds its breath. And then green techs.
Yeah, the clearing node comes back online, the margin engine is online, the 𝗥𝗂𝗃𝗁 processor is online, novation is active, the vacation is officially over.
And immediately you feel the system exhale. The recovery doesn't feel like a dramatic rescue. It just feels like the room breathing again. The OCC steps back into the middle of the floor. 50 million contracts instantly remember who their counterparty is.
The default waterfall springs into action and flawlessly absorbs Icarus capital, layer by layer, seizing their margin, paying out the funds just as it was designed to do. The pension fund gets its payout and never even knows how close it came to disaster.
And what about our guy, Dave?
Down in Ohio, Dave's grayed out button quietly turns blue again. The frozen expiration from Friday finally resolves. His covered call, it turns out, had expired out of the money after all.
Ah, nice.
Yeah, nobody manually exercised it against him during the blackout. He kept his shares, he kept his premium, and his $4,500 roof fund was released from limbo. He had been perfectly uselessly solvent the entire time.
The dealers, meanwhile, can finally trade options again to fix their gamma risk, so they stop mechanically dumping raw stock. The chart hooks upward, the market stabilizes. And what I find so fascinating, the perfect cherry on top of this story, is that the news anchors on TV just brush it off. They call the morning crash a temporary liquidity pocket. They have absolutely no idea what really happened or how near the whole silent machine came to switching off permanently.
Maya realizes it at the end. The fact that nobody knows the OCC's name, that the news anchors don't even know it exists, is not a design flaw. That is the entire point. True systemic infrastructure is supposed to be completely invisible. You only learn the name of the plumbing on the day it stops working.
So what does this all mean? We just spent this deep dive looking at a fictional comedic thriller to understand the very real, very hidden plumbing of our financial system. We rely entirely on silent, automated trust in systems we frankly do not understand. We take for granted that the billionaire bouncer is always going to be standing in the middle of the room, guaranteeing our tabs.
We trust the ladder of margin, the layers of the default waterfalls, the automated 𝗥 by 𝗥 sweeps, and we assume that because we are a good node doing everything right, like Dave in Ohio, we're inherently safe. But as Dave learned the hard way, being perfectly solvent doesn't matter for a second if the machine verifying that solvency decides to take a break.
Which leaves us with this final thought for you to ponder. We've just explored the absolute chaos caused when one invisible financial machine takes a vacation. But look around your own life. Look at your own industry, your daily routines, your digital habits. What is the silent, automated system holding up your world right now completely unnoticed that is just one out-of-office message away from bringing everything crashing down?